Bloomberg Audio Studios. Podcasts, radio, news.
You're listening to Bloomberg UK Politics. I'm Lizzy Burden.
And I'm James Woolcock.
And it's Tuesday, which means it's a special podcast. James and I have just hot-footed it over from near the Tower of London. We had a beautiful view of it. And we were just in a room with the UK Chancellor of the Exchequer Rachel Reeves and 17 pension fund CEOs signing, not us, them, a new version of the Mansion House Accord.
Well, it doesn't happen every day, Lizzy. Yeah, the most important thing that doesn't happen every day was that it was sunny in London. And the second thing that doesn't happen every day is you get to interview the Chancellor of the Exchequer, Rachel Reeves.
It was a great opportunity to talk through this latest development. So you'll remember back in 2023, Jeremy Hunt, when he was the Conservative Chancellor, signed the Mansion House Compact. Well, Rachel Reeves has built on that today with the Mansion House Accord. So you've got 17 pension funds volunteering to invest at least 10% in private markets by 2030 and 5% will be allocated to the UK. We started by talking about that fundamental conflict in this policy between maximising returns for pension funds and boosting UK economic growth.
Well, we do need to achieve both, and we improve returns for savers in the UK. And I know that people every month that save for their pension are making big sacrifices in doing that. I want them to know that they're getting the very best return on that money, which means a more diversified portfolio, including investing in fast-growing businesses and also in infrastructure. And what's welcome today is that 17 companies representing 90% of active pension savers have signed this accord, which means that now 10% of what they invest will be in these private assets. And for the first time ever, a proportion of those, half of those, will be in UK assets. That's good for the UK economy, more money into the UK economy, but it's also good for savers.
So if you're confident it's good for savers and for the economy, why not mandate these pension funds to invest in UK assets?
We don't need to mandate them if people are willing to sign a voluntary accord. And today we've shown that that is possible, with 17 businesses representing 90% of active savers signing up voluntarily to this, because they know that it is in the interests of the savers whose money they invest. The challenge up until now has been that no company wants to go first. And so this coordination, that's the role that government can play. And the work that myself and our pensions minister, Torsten Bell, have done is to bring the industry together in a way that hasn't been achieved before, to ensure that the market will move together and send a very clear signal that the best way to deliver for savers is to have a more diversified portfolio.
But if they don't comply, because a one-year review of the original Mansion House Compact showed only limited progress in terms of assets invested, is there a point at which you would mandate pension funds to invest in UK projects?
I'm never going to say never, but I don't think it's necessary. Because what we saw today was 17 pension funds representing the vast proportion of pension savers in the UK deciding voluntarily to do this. And what they wanted was a government that was willing to corral and bring together the industry to ensure that they can best ensure that their savers, their customers, are better served. And so I'm really pleased with what we've been able to do. It shows that you don't need to use mandation if you can work together, have that compelling argument, and also crucially, and this is so important, have the pipeline of investments. Because another thing that pension funds have said to me is, we'd love to invest more in private assets, we'd love to invest in infrastructure if we had that pipeline of projects. And that's what our 10-year infrastructure plan will enable. There's a number of investable projects, whether that's the Lower Thames crossing, whether it is investment at Heathrow or Euston Station, or projects around the country, from rail in the north to gigafactories. There's so many investments that can be made, but that plan gives them that.
Why focus on private markets when the London public market needs such help? There's a stark valuation gap between the UK and the US. Why not help out?
Well, of course, AIM shares are included in this, so it's not the case that no listed equities are included in the announcement today. But what start-up and scale-up businesses say to me is that they end up listing abroad because they raise capital abroad. And one scale-up business, a really successful UK scale-up business, said to me was that every time that they raise money, they become a bit more American. And so the point here is that our fast-growing businesses will be able to raise money through that long-term investment from pension funds, and therefore will stay in the UK and will list in the UK. So this is good for UK stock markets too.
Well, you said never say never on mandation. Would there ever be mandating to invest in UK-listed equities?
I think that what we've done today shows that we don't need to use mandation.
But you're not ruling it out?
There's a willingness from businesses to do this voluntarily in line with their fiduciary duties to ensure best value for their savers. And today just shows what government and business can do, working in partnership, delivering for working people who in the end are going to be forefront of our minds, because it is their money that is being saved, their money put aside for retirement, and we've got a shared interest, government, business, and most of all on behalf of working people, to ensure that that money works for them.
Chancellor, if we can turn to another issue top of mind here in the city, are you concerned that your non-dom tax changes will cost more than they raise?
No, I'm not concerned. We've had numbers produced by the Independent Office of Budget Responsibility, who forecast that a combination of those rules, but also the temporary repatriation facility, will bring in money for the Exchequer. When I became Chancellor last year, I faced a big black hole in the public finances. We needed to take immediate action to deal with that. We made a manifesto commitment to ensure that non-doms do pay their fair share of tax in the UK, but combined with a temporary repatriation facility, which makes it easier for people to bring money into the UK without facing punitive tax, is what has convinced the Office of Budget Responsibility and other forecasters to say that this will raise money for the Exchequer, money that's much needed to invest, for example, in defence.
But the OBR's modelling assumes that non-doms won't leave as a result of your policy,
not
and
true.
they've admitted that it's very uncertain.
Yeah, the Office of Budget Responsibility do forecast that a number of non-doms will leave the country, and indeed every year you have huge flows of people in and out of the country. This is a highly mobile group of people, but as well as people leaving the UK for a whole variety of reasons, we have every year thousands of people, including some of the wealthiest people, come to the UK because they can see that this is a great place to do business, a great place to grow a business. And you saw yesterday in the immigration white paper a real shift in our policies around immigration towards higher skill, higher value people coming into the UK to better support our economy.
And Chancellor, I was interested to hear the Prime Minister saying that immigration doesn't boost economic growth. That directly contradicts the OBR. So who's right, the Prime Minister or the OBR?
Well, of course, immigration can be good for the UK economy, but you've got to get the right type of immigration. Just bringing in more low-skilled workers is not going to make people here in Britain better off, and that is the number one priority of this government. We do need to get the numbers down. More than almost 1 million people net migration is a city the size of Birmingham coming into the UK every year. That's clearly not sustainable for our public services, for our housing. And when we've got 9 million people in the UK who are economically inactive of working age, it's quite clear that our priority has got to be, as it is through our welfare reforms, of getting people back into work by giving them the support and training that they need.
If more people doesn't necessarily equal more growth, though, does that rule out the government agreeing to a slimmed-down version of the EU's youth mobility scheme?
Well, we've got the EU-UK summit next Monday. Negotiations are ongoing ahead of that. But we were clear in our manifesto, there will be no return to free movement under this Labour government. You can see that finally we've got a government that is trying to get a grip of uncontrolled migration. But of course we want Britain to be a place that welcomes entrepreneurs, researchers, the best talent, because that is something that makes our country a great place.
So that was the UK Chancellor of the Exchequer, Rachel Reeves, speaking to us off the back of signing that new version of the Mansion House Accord.
Well, never say never, Lizzy. That was, I think, very interesting to hear her refusing to rule out forcing the big pension funds. Now, for me, I always come back when thinking about the Chancellor back to the Mays lecture she gave a few years back.
She would like that. That's what she wants you to think of.
Well, it's her 3 pillars of how she would fix the UK economy. Stability, investment, reform. This is the investment. This is how she would get projects theoretically back into the UK. She's always said private investment is the secret sauce, and now she's got this agreement with pension funds to put money back in. But one of the key problems here is going to be delivery. Now, we had Andy Briggs, the CEO of Phoenix, which is the UK's largest pension fund, on Bloomberg after Reeves' announcement. He's also focused on delivery.
This needs dedicated focus. What we've announced today is an intent, a direction of travel, which is great, but what matters is the actual execution. Unless we get this money invested, we won't get the returns for customers, we won't get the benefit on the broader economy.
Now is weirdly where the difficult bit begins. There has to be big infrastructure projects, and they have to deliver returns back to these pension funds, because these aren't just big corporate behemoths, they are people's life savings, and if they aren't making money back, that is also going to hit the UK economy in its own way.
Well, yeah, that is their fiduciary duty, which is exactly the conflict we started the conversation on. But this question of execution comes back to why it isn't already happening. We've already had a Mansion House Pact, and that one-year review that I was referring to is by the Association of British Insurers. That showed only limited progress in terms of assets invested. The signatories held the equivalent of just 0.36% of the total value of their DC default funds in private assets, and they cited key operational and technical barriers to investment in private assets. So the excuses are there. Why is it going to be any different this time? Just because they're committing to a bigger percentage allocation, the actual mechanism remains voluntary. Or will it forever? Maybe this is opening the door to Mansion House 3.0, 4.0. When do we eventually see the mandation that, as you say, Reeves did not rule out?
Well, and then the other side of this is to go back to those 3 pillars is stability. The Labour government had maintained all the way through the election campaign, when it was yet to be a government, that it would take power, stability would come, and capital would flood in. Yet when we come and look at the mega wealthy, some early rumours are suggesting that actually quite the opposite of happening, and some of the richest people are leaving. This is the sort of non-doms where they're responding to tax incentives, potentially pushing them away from the UK.
Yeah, certainly something that we've been hearing at Bloomberg is that they are departing or planning to depart, and it's big names, high-profile names like Goldman Sachs' Richard Noddy.
The Livingston brothers, they are like real estate magnates. And also a lot of the city, it's said here, 1 in 5 city bankers are non-doms. So if this is true, the OBR puts it at 12% leaving. Some early estimates from other academics say it could be as high as 40%. It's very hard to measure, but that would be a fiscal hole in sort of Reeves's budget, as we're already seeing a lot of uncertainty mounting about the growth outlook.
Yeah, you had a fantastic story about this report from the Centre for Economics and Business Research on their estimate of how much it would cost rather than raise the Treasury if you saw non-doms actually leaving and this wealth exodus actually becoming a headache for the Treasury.
I mean, they all say it's at 25%. That's at the moment you start to lose money. And as we're sort of discovering today, the one thing we want to get is more money back into the UK, be it private or public. Well,
finally, we ended on the immigration point. I thought it was interesting that the Chancellor opened the door to Keir Starmer's remarks on immigration, and looking ahead to that UK-EU summit on May the 19th.
So it's interesting that they push on the OBR, because when it comes to the OBR's estimates on non-doms, it's 12%. And she pushed that as the sort of estimate we should trust. When it came to immigration, you asked about the OBR in the other direction. And there, it was a lot more mixed.
The sort of immigrants have to be the right sort of immigrants, not the sort of thing that you would usually hear from Labour, but you would hear in the context of fending off the threat or trying to fend off the threat from Nigel Farage's Reform UK. But I remember interviewing Rachel Reeves when she was Shadow Chancellor and how critical she was of Liz Truss as Prime Minister for questioning the OBR's methodology. So it is interesting to me that they're only interested in the OBR's analysis when it suits them, when it's certain kinds of immigrants.
That's it from us for today. If you like the programme, don't forget to subscribe and give it 5 stars so other people can find it on Apple Podcasts, Spotify or wherever you listen.
And this episode was produced and co-anchored by James Woolcock. I'm Lizzy Burden. We'll be back tomorrow. This is Bloomberg.